I wanted to make a video to show you my process of every morning when I wake up, what I do, how I find the stocks to trade in, or at least to basically which stocks to consider, but every morning depending on the market. So I've already got my system opened up, and this is my $5,000 fund, which is basically my play money, or not really play money. I never would say that. But it is a fund that I started with $5,000. I built it up, and today I'm going to show you exactly what I'm looking at, my thought process, and hopefully become or get you to become a better trader and investor. These are strategies that I do use mostly in a sideways market, and I'm going to go over this with you. I'm going to start doing these videos more and more often, and that's why I'm going to open up the investingondemand.com website to give you that all access to what I, basically my theory, my strategy, my thinking, and how I research stocks. So there's three of these that I have open. That is Boeing, General Electric, and Space. If you don't know or haven't heard of Space, it is the Virgin Galactic Holdings, which is owned by Mr. Bronson. It is kind of a new stock. It's hit IPO, or it's basically IPO, and it is kind of starting to make its move. I'm not going to say it's going to be the next $100, $300 stock. We don't know that, but it is fairly new, and it is looking promising. We see SpaceX go up with Elon Musk, the Starlink satellites, and so on in space. And Richard Bronson has just, in the last couple weeks or months, landed a contract with NASA. So I basically put on a poor man's covered call. And what that poor man's covered call is basically, instead of owning 100 shares, you're owning a contract, the right to buy, but not the obligation, to purchase said stock within a certain date. And as you can see, these have about 575 days, each one of these on the long. And when you hear the word long, it's usually mean you're in it for the long run, or you've bought it and you're holding on to it for the long. When you go short is when you're selling it. So basically, I bought contracts, one each, two here for General Electric and then one for Boeing, about 575 days. At the time, I think it was 600 and some days. Trades, I've actually held on to this since last month, around the 8th. And as you can see, it gives you the time, 10:22 in the morning. This one, basically, I'd set up just a couple, it's been about earlier this month. And then this one, I've been working it just recently in the last couple days, actually 2 days. But I've already sold a couple covered calls on here and have made money. So this one's up to 290. Some of the others were, I believe, 80 and then 120 right after that. And that's simply because this is moving away from the 205. It is going down. And as you can see, it's basically going to hedge a loss. So on your long, you're obviously going to lose money, but then you're going to be picking it up because I have a contract for those who have bought this 205 to purchase it if it goes up. So if it goes to 210 or even just 205.99, 206, 210, 230, 300, etc., they have the right to buy this only at the 205, and I have to get rid of this contract. But here's the goal, and I'm going to go into this with you. I open my system up, and this is my screen. Sometimes it looks like this for many of you if you don't open these up. It's just quick viewing of what these are currently doing. However, on the shorts, it did not show that. So I want to see the profits or the shorts of what they're doing as well. 285 here, only $1 so far here, and then 36 bucks on Space. Now, I do open up a couple of websites. These are free. They do have premium versions. This is gurufocus.com, discoverci.com, barchart.com, and last but not least, thewellwisdom.com. And I'm going to go over these with you. Guru Focus is basically value investing for following gurus like Warren Buffett, Carl Icahn, Peter Lynch, et cetera, and see what those guys are doing. But the cool thing with this is, if we go into Boeing, for instance, it's going to give us a couple things. I know in a couple of my courses, I showed you how to evaluate a stock, basically determine its intrinsic value, and determine whether or not it's a good possible long investment or even a short investment. But this website gives you a quick overview and a lot of the important ratios, the profitability ranks, the financial strengths, etc., and so on and so on. We can see their debt to cash, PS ratio, enterprise value to EBIT, enterprise value to EBITDA, and then so on and so on here. If we look at the DCF, discounted cash flow, this can take us all of what the current stock is doing and determine the margin of safety. Now, as you can see, it's not available in here because I hadn't set it to what I want to determine. This is probably going off a default, and I'm going to correlate this with another platform that I use, and that's this Discover CI. This too is free, but you can also upgrade to Pro. I'll scroll down here to Bank of America, or not Bank of America, I'm sorry, Boeing. It's right here. And another thing that I want to talk about is Boeing is a governmental backed commercial flight brand. I mean, let's just face that. It's one of those stocks where you have to think about, will it go out of business? Well, every time there's an issue with the economy, such as this COVID crisis, we've seen a bailout. And it's one of those stocks, I hate to say the term or even mention the term, but it's too big to fail. While the term's not always true, you gotta think of the government-backed brands that do exist in society in economical times like this, and understand that 9 times out of 10 they're probably going to get bailed out because commercial flight drives the economy and something that the government does not want to lose. So anyways, I'm going to go over here to the stock valuation tool, and this does give a little bit dangerous perspective, and it's giving me an intrinsic value, meaning today the future price of what it's really worth today is actually 47, and the downside risk is 266%. But given the financial crisis, this has dropped tremendously. We see the growth rate is given at 8.11%. Its normalized EBITDA is 5 trillion, sorry, 5 billion. And then the reinvestment rate is almost 20%. Its weighted average cost of capital is 13.23. Its risk-free rate is set at 3. Tax rate at 21. And then we have terminal inputs. And what is terminal inputs? That's pretty much the entire lifetime or the remainder of the business in the future aspect. So we have a reinvestment rate set at 17.45, a growth rate at 2.0, a debt ratio at 31.56, and then again the weighted cost of capital actually decreases to basically 11.46. If we take a look at the Guru Focus website, we can see some of these numbers. They've got it set at the growth stages at 10 years. However, do we want to really think that Boeing is in a growth stage anymore? I mean, Boeing has existed for quite a while now. Most growth stages I like to set anywhere from 5 to 10 years, and then after that it goes into terminal stage. So we're well past this. For an IPO perspective, this is good to use. So normally we can either just wipe this out and set a growth rate at 5%, 19%, 4%, whatever we expect Boeing to grow at. Now I'm going to say, let's just do a very conservative number. Actually, we can set that to 0. And then the years, I'm going to say Boeing's going to live for another 35 years. Its growth rate is going to be set at 22. And the fair value is actually giving us a negative 14 evaluation. But we can see that this is based off the earnings without the NRI. If we set it to future cash flow, it drops even more. And we're also discounting at 12%. Boeing could be considered a little bit safer, but as you can see there, it drops even more. So we got to think a lot of things. What they're selling their bonds off at, and then the discount rate has to be more than a bond because equity is more expensive or more risky than debt. And just remember that. That's in one of my courses over at investingwithchris.com where I explain equity is much more expensive or much more risky than debt. And that's why you see corporate bonds, government bonds at a low interest rate, because they're almost guaranteed at that rate. So for instance, a government bond that's paying 2 to 3%, you're going to get the 2 to 3% almost guaranteed. Same thing with a business like Apple or for this example, Boeing. When they sell their bonds, guess what? You're probably going to get that interest rate on your investment or on that bond. Unlike equity, you might invest in their stocks, and then guess what? It may go down depending. But anyways, as you can see, this is just a user-defined discounted cash flow. This has changed. It's actually a lot different than the last time I checked it. I don't use this unless I'm going into a stock long term. When I'm doing these option contracts, as you can see, I don't really need to know way far out. It's more of a numbers game, and it's almost based upon statistics and percentages of what I'm going to be looking at, and the risk, or basically the system tells me the chance of making that kind of money. But I just want to show you the 4 websites or 4 companies that I do use to check certain things. This Well Wisdom will show you the hedge funds and the world's best investors and what they're trading and investing in currently. If we take Boeing for the example again, we're going to click on this and we're going to see the top, how many hedge funds it's held by, the most recent filings, and so on and so on, and whether they've changed in shares, prior percentage of portfolio. So we get to see the size of Boeing compared to the rest of their portfolio, the market value of their investment of Boeing, and so on and so on. And this is actually a pretty good resource, because the way I see it is, you follow the money. They know what they're doing. They have lots of money to invest with, millions, sometimes billions of dollars. So if they're throwing that money to this Boeing, it's usually going to inflate the price. So if you're quick in knowing which investors are going to be buying up a number of shares and how much, guess what? That stock will tend to climb, because they do push the numbers up. The system or strategy or the market's much bigger than you and I as an individual investor. So we want to be able to be the most resourceful that we can when it comes to investing. And these websites I strongly use, I believe in, and I just want to throw these out to you. The Guru Focus, I've got an affiliate program or affiliate link with these, but anyone can use it. If you don't sign up, it's free. You can get most of the stuff that you do need and correlate it with each of these websites. If you do go to the premium version, it's basically just going to show you the 30-year financials much further back. As you can see, it only goes back 5 years, and if you want to see more than that, you've got to have the premium version. The Guru Trades, this is similar to this 13, what we call in the investment world a 13F. That's hedge funds and their filings and when they buy and sell. So anytime you hear this magical term and ridiculous misunderstanding of insider trading, it's anytime basically someone has information about a company before the public gets to know about it. So if they don't say that they're going to sell out, or they buy and they've had information on, for example, Apple or someone was to buy so many gadgets or invest so many millions of dollars into the next big thing, and the numbers, they've already got pre-orders in, and they don't share that with the public, then guess what? That's insider trading. But anyways, this is back to the 13F filings along with the Guru Focus. We can see the number of gurus or Guru sells, the number of Guru buys, and then that price. And then this gives you the listing. As you can see, it was last quarter, or on the 3rd, March, and this is June down here. So we can see the difference. I'm just showing you the 2 dates there's almost a 3-month difference. So that's not too soon that I need to know. This is too far back. This really doesn't give me any clue as to what's going on. But if you want the real-time picks, again, it's the premium version. But anyways, oh, look, my best friend, sarcasm, George Soros, he's invested into Boeing back on September 30th, 2019, so last year. Now, if I kind of want to go into, and I don't want to talk conspiracies or anything, but this is something you do have to think about as an investor. We know that September he invested in and December. Okay, a lot of people, and I'm not a fan of I'm just going to keep it neutral. We know that some things are led by politics. So we as an investor has to understand what they're going to be doing to drive the economy. And he actually added it. I would had actually said that he may have sold, but here again, right here's a sell. So if we look, he added, where does it say, 49,000. Here he added 5,000, so about 55,000. Then all of a sudden he shorted, sold out, and now he has zero. So he sold out all of his shares in March. The COVID crisis hit around February to March. So we can kind of look at this and say, okay, we've got Joel, David, Michael Price, Dodge and Cox, Mario, George, all selling out. Sorry, not Mario. All selling out their shares. And just right here, T. Rowe Price just added. So they went the opposite direction. They went that way. But Ken Fisher reduced, these increased, and T. Rowe Price also increased. So a thing that we can remember is that what they're investing in, we can follow our preferred gurus or whatever and see what they're actually investing in and what they're doing, or maybe even selling. J.P. Morgan and Chase, DuPont, Raymond James, Delta Airlines, so on and so on. So a lot of these are given to us 3 months back. If we want real time, we would have to upgrade. So keep this in mind. This is the 4 resources, the 4 websites that I do use. Now, let's get back to the system. The goal of a poor man's covered call is, instead of buying Boeing at today's price, so I'm going to go and trade, and I'm going to look at, it's currently trading at 174. So instead of going right away and buying at 174, I'm going to assume that yes, Boeing will go up. I just don't know how much. Instead of playing the guessing game, I can do what is called, that I like to do, mutual fund advisors, 401k portfolio managers do, is something called a poor man's covered call. For example, if I spend $5,000 or invest something in a contract of $5,000, and every month I can sell that contract for a different price for a certain amount of return, 10%, 20%, would you do it? Most certainly. If you look at real estate, for example, it's very similar to real estate investing. When you want to buy anywhere from, whatever the cost of the house is, for example, $250, you might have to put down 4, 5, maybe 10%. Well, that's $20,000. By the time you put a tenant in there, if you go the renting route, you have to make enough for bills or future bills, plan ahead, the mortgage payment, and then make a little money on the side. Or if you do a fix and flip, you're putting up capital up front or other people's money, and then you're basically flipping it for a higher price. So for this example in Boeing, I went out 575 days. That means I have almost over, right around or less than 2 years for this contract to work in my favor. I want it to stay above 110, obviously, because I would then almost lose all of my money in that. But here's the case. We're looking at Boeing at 575. A couple rules to this is, and keep this in mind, jot this down, you do not want to pay more for the contract than if you was just to outright buy that strike price or the price at Boeing, whatever you're looking at this contract. So I have a 110 right here position. It's now valued at 86, in between 82. There's a spread. That's what the market makers make their money on. So there's someone selling this thing for 82, but we have to buy it for 86. Okay, so this is at the 110. If I was just to buy this, it'd be 100 shares at the 110. So let me pull up my magical calculator here. And that's $11,000. Well, we're literally handling an $11,000 position for only current time 8,000. At the time of this trade, I go back in here, right click, view trades. So 2 days ago, I bought this thing for $9,500 or $9,570. It's now at 84, but that's fine. I've made money by selling covered calls and buying them back. I go in the trade tab, and remember, I said do not pay more than if you was just to buy this thing outright. So we don't want to pay more than $11,000 for this thing. It just does not make sense. So we're looking at our deltas. I like a delta anywhere from 80 to 90 because every point up this contract goes up by that much, plus the gamma. But as you can see right now, this far out, they don't have any gamma. So if this thing was to go to 175, I would make $84. That contract would change by $84. Now on theta, this thing is losing value at $3 a day. So every day that goes by, this thing's losing $3. It has to move up for me to make money. Or tomorrow, it's going to be $81 less than it is today. That's because $84, if it moves down or stays the same, it's losing $3. So now, it has to move 1 point up, 2 points up, 3 points up, so on and so on to make that money back. It's not much, but it is something. That's also something to think about. Okay, so what I do in my system, I look at the premiums. I see that in almost 2 years, do I think Boeing will go down to 110? Probably not. We can look at these percentages. We can look at this delta, and this says that 83% that this stock will be above 110 or at 110 at 575 days. The system over here is saying it has a 61% to go plus or minus 130. So that means it could be 300 or it could be 0, pretty much, or 40 points. Let's say 40. Will it? It has a 61% chance, plus or minus. Doesn't say which way. It just says one way or the other. Okay, so I know that this is now cheaper than the 100 shares. So I'm going to go ahead and invest. And at the time, I invested $9,500. So I'm still under the 11,000 mark. I would add that to the 110, my investment, 9,500. Actually, it's 70. Let me do this the right way. Plus 110. It's actually going to be 11,000. This is now my break even, 205.70. And I say that because I divide this by 100, and that's 205.70. That's my strike price that I do not want to sell covered calls less than. And why is that? Because when we're buying this contract at 110, and then we're selling it 36 days, 29 days, or whatever to make premium, if the stock happens to trade over this 205.7, guess what the other guy that's going to do when you sold this contract? He's going to exercise the short. So then what happens is your broker's going to automatically position you with 100 shares at 110 and then sell them at the 205, for example, or whatever strike price you short. So if you cut yourself short and go 200, you're now $570 loss between the two strike prices at the 110 and the 205, because if we subtract 110 from this times 100, that will give me this break even at 950.70. So right there I break even on the contracts or the sale of the asset, but whatever I short, so for example 205, in 36 days I short this thing for $560, that's now my profit. We can basically forget the 205 because we exceeded the two strike prices to break even, but now I'm making the premium for sure. We can go up a little more. We can go 207, so it would sell the difference between 110 and 207, which would pick up $200 there plus the 545. But I always shoot for the better return. This one I'm only losing 15. This one's 50, so you could actually sell this try to squeeze that up to 660. It's going to start out at 570. I always move my slider up because I want the better of the split. And the split is, remember, the market makers make the money off the difference between the bid and the ask. But you can move these up, and you could possibly get $615. I could get out these two. I could go up to the 210. If it doesn't hit 210, I just take 510. So just keep that in mind. I could go a little bit lower. I'll lose $300 on the two splits, but then I'll make $650. So you do 300 minus the extra $100 that you're making. Now you just lost $200. You're still getting $400 and some dollars here on this one. If that's too much, I can always explain it to you if you just message me or whatever on Poor Man's Covered Calls. My email, it's on the website at investingwithchris.com, and I also have something in the comments section to always explain these videos to you guys. But let's do the math. I've got a $9,000 investment, and right now I'm in a position. Let me get this out off of here. Close this out. Why is this open? Trade grid. Okay, so let's go back to see what I'm working with. I've got a 205 call selling against the 110 at $9,500. Originally, I shorted it for $11.20, and it's now down to $8.80. I can buy this thing back for a $200 profit. So I'm shorting, or I'm writing a contract option where someone else is buying it. So I'm selling it to someone right away. They've just bought it, and now I can buy it from someone else a little bit cheaper. So the system is going to basically be 1,100, which I shorted. I'm making premium off 9,500, and that gives me 11.5% return for literally 57 days. I can do 36 days. I can do whatever. 57 days gives me plenty of time to make 11.5%. I just do this all over again if it does not go above my strike price. So 11.5%, I just showed you how to make a decent return every 57 days, 60 days. You do this over and over again, you'll have that 9,500 paid off, and then this is basically for free. You can exercise it, you can just sell it, whatever you want to do. I prefer usually to keep it depending on the price. If it's up and I can keep my contracts, then I just keep selling covered calls. It's basically renting out your stock for free, and that's where you'll get a better explanation in my book on investingwithchris.com, is how to make money off your stocks, renting them out like real estate. So that's it for this video. Investingwithchris.com, investing on demand. And if there's ever any questions, drop them in the comments, subscribe to my YouTube, and I'll see you in the next video.